put it all in some market context. Philip Petursson is Chief Investment Strategist at IG Wealth Management and one of our regular guests. And Philip, it's good to see you.
Good to be here.
Okay, let's start with the economy, maybe through the lens of the retail sales. Anything to take away from the numbers today?
Well, one data point doesn't make a trend, and that's what we have to focus on. If this is a continuation or if this continues to be positive into January, February, March in the first quarter, that's good. That shows that the Canadian economy is holding up well against the forces of increased mortgage payments that is weighing on the consumer. But I don't think this is going to be a trend. I think this is going to be a little bit more seasonal. It's Christmas. People are going to spend a little bit more, but then it's going to come back to getting those credit card statements and being focused on paying that down at the same time as paying a higher mortgage cost.
So let me just throw a few, potato chips on the table here. Like I mentioned, the inflation numbers recently showed that there's still a fight against inflation. Mm-hmm. Here we have 2 months of retail sales data, one soft, one a little bit stronger. We mentioned the December jobs numbers for Canada, fairly soft. So if you're the Bank of Canada, and I mentioned that they're not expected to make a move on rates next week, but how are you supposed to make sense of all of this?
I think they're getting ready for a rate cut. Okay. I think there's clear evidence that the Canadian economy is slowing down, and in that, while that inflation number was a little bit higher, it was right in line with what we expected when you model it out. And that's dropping off a very low number a year ago to pick up a little bit of a higher number. But a lot of that inflation is coming from mortgage interest costs. So the Bank of Canada has to be aware of that, realizing that if they actually cut interest or cut the interest rate, the overnight rate, they will be supporting lower inflation, which is a good thing. Same time, we've had about 8 months, probably 9 months of no growth in Canada economically, and they have to be aware of that. We're on the verge of recession here. I would argue that parts of the economy are in a recession, and so they probably will be looking to cut, I wouldn't say quicker than April. April is the consensus expectation, but I think it could also be pushed into the summer, but by the summertime, they will be cutting.
And so how do you think about investing in a landscape like this?
From the interest rate perspective, look, bonds are attractive. They're offering us mid-single-digit returns, especially on the investment grade or high-yield space. I think with the view of interest rates coming down, that's good for bond investors as the price tends to move up. But from the stock market perspective, I think it could be even a little bit better. So this is the ultimate soft landing scenario, slower economic growth being in Canada or the United States without the significant higher unemployment. And so in the U.S., as you mentioned, it's a very different economy, a stronger consumer, and I think that bodes well for the stock market in 2024.
We're just showing these yield charts for government bonds in Canada and the U.S. It's not an easy game, though, these days. I mean, the fact that usually we tell it through the lens of the stock market, and we said that after growing expectations for rate cuts coming into the year, all of a sudden, whether it was because of pushback from Fed officials or some of the economic data, investors said, well, maybe we're moving too far too fast. But then if you were buying bonds, I suppose, late last year because you thought rate hikes were done and yields start going back up, then all of a sudden your bonds have been going down.
You are. And this is where you have to be very careful in terms of your positioning on the yield curve. And I would say, what you didn't want to be doing when bond yields, long-term bond yields went from close to 5% down to 4, below 4 for the U.S. 10-year Treasury, you want to be a little bit more focused on the shorter end of the curve. We do see longer-term bond yields inching up a little bit more from where we are, but not enough to drive bond returns negative. I mean, for the full course of the year, a diversified bond portfolio should achieve that mid-single-digit return.
Okay, just want to talk about the TSX for a second, which I mentioned is negative so far this year by about 1%. I mean, it's still early, but we keep talking tech. And tech stocks here are actually positive for the year. But you've got some of our important sectors, materials. There's a number of corporate stories involved in that, but people are watching what's happening with oil and gold. Obviously, we have the energy sector, which is negative this year, by the way, pretty choppy one. Financials had that nice run into the end of the year. They're down. So there's 1, 2, 3 powerhouse sectors of the Canadian market that are all negative so far this year. What's your take on that?
Well, I think it's a little bit of profit-taking and rebalancing, to be honest with you. We did have a very strong last 2 months of the year. Markets were up about 10% or so. And so what we get into the beginning of the year is just a little bit of a revaluation. I am a little surprised that energy hasn't been as stronger, given all of the geopolitical risk that's going on right now in the Middle East, but that's an area that I think is attractive.
And I noticed that some safety plays, namely like the communication services, that's like the telecom companies, consumer staples, they're actually the best performing sectors in Canada this year. So is that sort of playing into the idea of just take a little safety for now? Maybe he's locking in, you were talking about yields in the bond market, locking in some dividend yields, that kind of stuff?
Yeah, and I think that if the view is that over the course of the year, maybe not immediately, but over the course of the year, that interest rates are going to be coming down, then picking up attractive yields today where those yields, dividend yields, will be rewarded in a falling interest rate environment is an attractive place to be.
Okay,